We all know that Tether has a lot of skeletons in their closet and a lot of sketchy things going on in the background. But most recently, we had the S&P downgrade Tether to the worst possible rating for their stablecoin stability assessment and bringing to light the fact that Tether does not necessarily have 100% backing of the stablecoin. So, with that being said, is Tether on its way to a complete collapse, or is there just a simple issue here that can be solved? And what does all of this mean for the crypto market and traditional markets? And what exactly is the future path for Tether in the United States with the Genius Act being passed, basically saying that all of the activities that they're continuing to do are not going to fall within the regulatory framework in the US? If you want to understand this better and you want to see whether or not this is going to lead to the collapse of Tether, watch this until the end. I'm going to break this all down step by step. So, the world's largest stablecoin, Tether, was just downgraded by S&P to weak, which is the lowest score possible for a stablecoin. So, the reasoning for this essentially is because Tether holds too much Bitcoin, too much gold, there's too little transparency into the reserves of Tether, and just too many unanswered questions in general. So today, let's break down exactly what this means, why S&P cares, and whether Tether is actually at the risk of a complete collapse, and why this threat of it being downgraded, right, to the weakest possible level by the S&P 500 is actually important. What's actually going on here? So let's talk about what just happened, because I found this out because of Matthew Siegel, the recovering CFA on X, basically saying all of this occurred. So Tether stability rating reduced to weak by S&P is what he said. And he quoted this. This looks like it's coming from a Bloomberg terminal. Somebody reported this through the Bloomberg terminal. And so Bitcoin now represents around 5.6% of all USDT in circulation, exceeding the 3.9% over collateralization margin, indicating the reserve can no longer fully absorb a decline in the value of Bitcoin. So what this means is this. Tether is a stablecoin issuer. They are supposed to be able to back all of the stablecoins that they issue out to users one-to-one with treasuries, right? Or with any other cash equivalent. Now, with that, they're supposed to have a 3.9% over collateralization. So they're supposed to have at least around 4% more than what it is that they've actually issued on chain in treasuries. So with that being the case, with 5.6% of all of USDT in circulation being the value of that being in Bitcoin, right? That 4% buffer that they're supposed to have is not there, right? It's in Bitcoin. So if Bitcoin were to go to zero, then they wouldn't be over collateralized, right? They would have less tether, or excuse me, less assets backing all of the tether that has been issued. So that's the major thing that's going on here. Tether replied to this. Apparently, Matthew Siegel reported from the Bloomberg terminal saying that what Tether said was Tether strongly disagrees with the characterization presented in the report, which applies a legacy framework that fails to capture the nature, scale, and macroeconomic importance of digital native money and overlooks data that clearly demonstrates USDT's resilience, transparency, and global utility. So now it also added that it published a quarterly independent attestation on its reserves since 2021 and has never refused a redemption request from a verified user. So that part is, worth noting, right? They've never actually denied someone to be able to redeem their stablecoin for $1. But with that, right, these attestations are not full audits, and we all know that. Okay, so that's something that they've basically continued to dodge throughout all of this time. Now, someone commented and said, don't they have 100% backing with T-bills with the Bitcoin and gold as excess reserves? And Matthew Siegel replied, no. Once again, coming back to this idea of the over collateralization, right, that they should have, that they don't have. And instead, since 5.6% of all Tether in circulation is actually backed by Bitcoin, right, you've got essentially 94%, right, of all of the Tether in circulation that's actually backed with some sort of a cash equivalent. And that's, by the way, that's not including the gold too. So gold is around 7%. So there's really like less than 90% of all of the Tether in circulation is actually backed by cash equivalents. So let's keep talking. And that's from what I understand. You can correct me in the comments if I get that wrong somehow. So the thing that we want to understand here is like, what exactly is it that the S&P Global has done here? Like what was unclear was that the S&P actually in 2023 released their own stablecoin stability framework or whatever. And we'll talk about that in just a second. So Novakula Okami on X basically came out and said, hey, Tether, the stable company, just saw S&P cut its assessment rating from 4 to 5, the lowest possible rating, citing persistent gaps in disclosure and high-risk assets being held in reserves. Only in crypto would the bedrock stablecoin of crypto trading be viewed as so fundamentally risky. S&P noted high-risk reserve assets, persistent gaps in disclosure, lack of robust regulatory framework, no asset segregation, and limitations on primary redeemability. So now, someone commented and said, but S&P grades credit risk, not operational transparency. The rating dropped because they can't verify reserves, not because reserves are necessarily bad. That's a disclosure problem, not a solvency problem. So Novakula responded to this saying that S&P is not grading the credit risk here. They are grading stablecoins on a range of factors, including operational resiliency. You can't dismiss the lack of adequate disclosure, a perennial Tether problem that they won't solve. But you can't ignore S&P highlighting the risk that Tether has in its reserves. So holding risk reserves, backing a fiat-backed stablecoin is not permitted in every jurisdiction that has thus far passed stablecoin regulations, with one exception being El Salvador. Now, a couple of things that are really important to point out here. The first thing is that, yes, S&P has a stablecoin stability assessment. Okay, that's a totally different thing than S&P trying to grade the credit risk of the stablecoin. The credit risk meaning, are they going to be able to pay back the loans that they had if they were a bank? But they're not, right? Anyways, so, or someone paying back the loans if they were a bank, right? But it's not what's happening here. What's happening here is they're grading the actual stability of the stablecoin itself. In 2023, they launched a new metric for that. So the other thing that I wanted to talk on here is this idea that holding risk reserves backing a fiat-backed stablecoin, right? This is the major thing that we have to keep in mind, right? Why are stablecoins being backed with volatile assets? That never makes any sense, and it typically doesn't end well. We'll talk about the different types of stablecoins in just a moment. We'll also talk about why this is such a really big issue down the line. So please watch this until the very end. We're going to dive deep into this. So first off, let's understand the framework that S&P has for the stablecoin stability assessment. So essentially, there are a few core metrics that they're looking at, right? One of them being the credit risk is a part of this, which is the danger that the assets backing the stablecoin, like bonds, right, could default and then become worthless. So if a government, right, were to default on the actual bonds that are in the stablecoin issuer's holdings, then that would be credit risk, right? So obviously, U.S. Treasuries have the lowest credit risk. That's why Congress has said, hey, for the Genius Act, we want to make sure that the cash equivalents that you have are U.S. government treasuries. Okay, so that's what that's about there. Now, you also have market value risk. The risk that reserve assets like Bitcoin, gold, or commercial paper that they may have drop in price and no longer fully cover the stablecoin's liability. So this is the major issue, right, that S&P sees with Tether right now. They've got a bunch of Bitcoin and a bunch of gold on their balance sheet, using that to back the stable coins that they've now issued out. But if Bitcoin goes to zero, or if gold goes to zero, or even just cuts in half, right, then now you don't have enough to actually back, right, the redeemability of the stablecoins that have been issued. So that's a major problem. Now, the next thing is custody risk. The risk that these institutions holding the reserves mismanage, lose, freeze, or restrict access to those assets. So for instance, with Bitcoin, this is a real problem. What if somebody gets hacked and that Bitcoin is just gone overnight? So that's the other risk. It's not just that Bitcoin goes to zero, but that Bitcoin could also go to zero by getting hacked. Now, obviously, Tether is going to have some of the most strict requirements and process when it comes to safeguarding the security of their assets from a cybersecurity lens, but it's a real possibility in a way that's not the same when it comes to the financial system traditionally. Because with Bitcoin, if it gets hacked, it's gone. There is no system to help you get that back. Now, the other thing that they talk about is over collateralization and liquidation mechanisms. So extra collateral and automated sell-off systems that protect the stablecoin's peg when underlying assets fall in value. So for instance, there's a blockchain thing of this too, because there's no smart contract, right, that says that, oh, if assets get to where you're not over collateralized, or Bitcoin gets to a point to where you now have less than the amount that you would need to be able to give people their money back, I'm going to immediately sell the Bitcoin that we have and then make sure that everyone can redeem their stablecoins. That's not in place. That's not a real thing at the moment, right? So that's another thing that I guess S&P is ready to potentially start to track, right? Are there are mechanisms in place that are either automated or high risk standards that are in place to make sure that if there are any needs for liquidations, that they can actually be executed upon. Now, so they also then apply 5 other categories in this rating that they're doing for these stablecoins. One of them is governance, right? So what is the governance structure of the stablecoin? The other thing is the legal and regulatory framework. Where does the stablecoin actually exist? Under which laws are they responsible for? Redeemability and liquidity. We talked a little bit about that here. Tech and third-party dependencies. Is Tether doing their own self-custody? Are they custodying with Coinbase custody or BitGo? Things like that, right? Their track record. How long have they been around? Have they been able to have they had any incidents where a stablecoin has not actually offered redemption for their stablecoins and things of that nature? Have they had any hacking incidents or anything like that as well? So the final rating of what they're doing here may be equal to or lower than the asset assessment itself, right? So there's other things that they're looking at besides just the asset assessment. So let's talk a little bit about why Tether's gold exposure actually matters in the first place. Like, why is Tether buying up gold, and what does this really mean? So to understand why S&P is suddenly sounding the alarm on Tether's gold and Bitcoin exposure, let's talk about what's happening behind the scenes in the global gold market. Because it's not just that like Tether owns gold. What's happening here is that Tether is actually now one of the biggest gold buyers in the world, bigger than central banks who are buying up a lot of gold. So Tether outbought every central bank in Q3 2025. Gold is up 56% in 2025, hitting all-time highs on the fears of fiscal dominance, meaning governments spending and spending and spending, exploding sovereign debt, loose monetary policy, and declining trust in major currencies. So these macro risks have pushed countries like Kazakhstan, Brazil, Turkey, Russia, and China to aggressively expand their gold reserves, reinforcing gold as the ultimate safe haven asset. So the thing about this, right, is that we're flipping back and forth between the fact that Tether's buying both gold and Bitcoin because they're both volatile assets. But what's also really important here is that Tether actually holds more gold than it does Bitcoin in the actual money dollar value of the assets that they hold. And this is where big headlines were coming out about, like, okay, well, Tether is actually like, are they buying up? Are they believers in Bitcoin, or are they believers in gold? Like, what's happening here that feels like a contradiction to a lot of people in the crypto space? So anyways, Jefferies, one of the largest investment banks in the world, revealed that Tether actually bought these 26 tons of gold in Q3, which was more than any central bank in that time. So by now, right, by late September, Tether held 116 tons total, worth around $14 billion in gold alone. So gold is equal to around 7% of Tether's reserves. Okay, so the thing about this is that Tether has different branches. They also do have an actual commodity-backed stablecoin, right? A gold stablecoin called XAUT. And so they have more gold inside the Tether reserves, the USDT reserves, than they do the XAUT reserves by a lot. So there's only 12 tons that are tied to the gold token, but there's 116 tons in the USDT reserves. So Tether's not just dabbling in gold, they're becoming a structural force in the global bullion market and one of the largest buyers of gold in the world. So as USDT grows, Tether has been increasing the share of volatile or non-traditional assets that are backing it. So that's 7% in gold, 5.6% in Bitcoin. They have secured loans, corporate debt, commodities, and others in their reserves backing the stablecoin, which is supposed to be stable, but whatever. The thing about this is that Tether's actually doubling down on gold at the moment, even while the Genius Act was passed, and the US laws are telling them that they shouldn't be doing that if they want to operate in the US. They need to be one-to-one backed with US treasuries. So the Genius Act, the biggest stablecoin regulation in history, explicitly would ban this kind of activity of holding gold in your reserves for a stablecoin. So Genius compliant assets would have to be cash, treasury bills, or other highly liquid assets. So even after the law passed, Tether continued to increase its bullion purchases. Now let's talk about these different types of stablecoins really quickly, because Tether is playing in between all of them in a way. So you have fiat-backed stablecoins, which are stablecoins that are backed by traditional currencies, which are backed by treasuries, right? So that's what you see with Tether most of the time. That's what you have thought of Tether as. And same thing for Circle, right? Circle is backed one-to-one, ideally, with US treasuries. Then you have commodity-backed stablecoins. So you have stablecoins that aren't necessarily meant to be stable in the term of being worth $1, but instead are supposed to be stable in the terms of being tracking whatever commodity it is that is being backed, right? So for instance, Tether has XAUT. There's also Paxos has their own gold-backed stablecoin. It's not stable in the terms that it's $1. It's stable in the terms that it tracks the price of the underlying commodity being gold in this instance. And so that's what that is. You would have ideally one-to-one these commodity-backed stablecoins are backed 1-to-1, right? So if you buy 1 ounce of XAUT, then it should be backed by 1 ounce of real gold in the real world that's held in a vault. Then you have crypto-backed stablecoins, which are stablecoins that are over collateralized. You have DAI or Curve USD, and these are backed by crypto that's locked inside of smart contracts. They're transparent, they're volatile. They can be volatile, but they're at least over collateralized. So you also have, MakerDAO is the major one with the DAI token. The idea is that if you put up Ethereum into the MakerDAO organization, you can take 50% or whatever out off of that in DAI, being a stablecoin that is minted out or using smart contracts, right? So it's over collateralized. So if the value of the collateral goes down, then you would get liquidated and it would be sold to cover the backing of the stablecoins, right? We don't have that kind of mechanism in these traditional fiat-backed stablecoins yet, but we'll talk about that a little bit later. The other kind of a stablecoin is an algorithmic stablecoin. This does not necessarily have anything that actually backs it in traditional reserves, but instead the peg is maintained by incentives, minting and burning, or delta neutral strategies, or some sorts of derivative-based strategies where there's some sort of underlying contracts in the futures or options markets that are used to help stabilize the value of the stable coin. Now, I wanted to go over this because Tether already has XAUT and is also rolling out USAT, right? Because there's different ways that you can go about creating a stablecoin, and Tether is taking a different approach across the different stablecoins. So they have the gold-backed stablecoin, they have the USDT, right? But they're backing USDT with gold and Bitcoin, which doesn't make any sense. And now they're launching USAT, right, just to be compliant with US regulations, which I called this out from the beginning. Why is USAT even going to be a thing? What that means is that clearly USDT is not backed 1-to-1 with US treasuries, which a lot of people have been calling out for quite a long time, that there's a lot of funny business going on with Tether. And we're going to talk more about that in a bit. Stick with me here because we're going to wrap this all up and make it make sense. So watch this until the end. Now, as I said, Tether launched USAT, which does not hold any gold, but continued to load USDT with gold anyway, which is really weird. It means that they're basically saying that we don't care. We're just not going to basically be compliant with USDT in the US. We're going to have a different stablecoin for that anyways. So this puts Tether obviously at odds with US lawmakers and obviously also with S&P Stability Assessment Framework for the USDT token in particular. So let's move on a little bit. So with all of that said, the big thing about Tether is that over time, we've kind of had a hint that they're not fully backed, or at least that there's potentially some funny business going on in the background with Tether. So in 2017, by the way, there was this leak of documents called the Paradise Papers. And in this, there was a leak of 13.4 million offshore finance documents that expose hidden ownership structures and tax haven relationships among major corporations and individuals. In these papers, there was some documentation that revealed that Tether and a company called Bitfinex had shared beneficial owners, despite claiming that they were separate entities. So Bitfinex is an exchange, and Tether is a stablecoin. And apparently, there is integrated structure of the ownership, which wasn't disclosed at the time. And the reason this matters is because if you are an exchange, right, where transactions are taking place, and you have a stablecoin, right, which is supposed to be you're supposed to be able to trust that they're backing all of their transactions 1-to-1 with everything that they've issued. The problem is that if you're an exchange and a stablecoin at the same time, then you can mint stablecoins out of nowhere and use those stablecoins to go out and buy real assets like Bitcoin or any other cryptocurrency as an example. And so that is what people started to call out. They were like, wait a minute, is it possible that Bitfinex is actually pumping and supporting the price of Bitcoin by just creating these new stablecoins and using those new stablecoins that aren't backed by anything and going out and buying Bitcoin with it? Okay, so this is a really big problem. So in 2019, this led to class action lawsuits, where there were lawsuits that alleged that a coordinated scheme between Tether and Bitfinex was used to manipulate the crypto markets. And the core accusations were that USDT was not fully backed, USDT issuance was used to pump Bitcoin's price during the 2017 run-up, and that Tether allegedly printed billions of unbacked tokens and sent them to Bitfinex. So Bitfinex allegedly used USD purchases to absorb sell pressure and prevent crashes. So the plaintiffs used blockchain forensics, okay, showing patterns like huge amounts of newly printed USDT flow to specific Bitfinex-controlled wallets, large Bitcoin buy orders shortly following the minting, and the Bitcoin price increased often coinciding with the exact timing of USDT issuance. So there was the class action lawsuit, but then there was also a New York Attorney General investigation that said that there was a missing $850 million, a cover up, in a bunch of cover ups, and then that actually led to an $18.5 million settlement. So basically, this was the most damaging and concrete official finding. What the New York Attorney General found was that Bitfinex secretly lost $850 million to Crypto Capital Corp, which is a shadow banking operation. Bitfinex then borrowed from Tether's reserves up to $900 million to cover customer withdrawals. This directly violated their public statements that USDT was always 100% backed. And so the Attorney General of New York called this a cover-up. Tether and Bitfinex publicly denied any issues. Privately, they were moving money around to hide the loss, and the New York Attorney General forced him to stop serving New York residents and fine them $18.5 million. So that court case said Tether was not always fully backed, even when they were telling you that they were. Okay, so this is something that already occurred. This really did happen. So on top of that, in 2021, the CFTC also fined USDT for falsely claiming that they were 100% fiat backed. The CFTC found that between 2016 and 2018, that Tether only had a full fiat backing for 27% of days in that period. 1 out of every 4 days, essentially. On other days, reserves were partially backed by commercial paper, loans, and other assets. Some reserves were held in Deltec Bank in the Bahamas and not insured by U.S. accounts. So, U.S. insured accounts. So Tether repeatedly misrepresented the nature and safety of its reserves. So this has always been an issue, has Tether actually been fully backed? And with that, are they also potentially manipulating the prices of the entire cryptocurrency market as they go about their business? So this has been settled in court that technically they were not always backed. The question of whether or not they were manipulating prices might not have been fully settled in court, but it did come out in these in these Paradise Papers that there was like some emails being sent back and forth where people were literally saying that we need to like pump the price of Bitcoin right now. So anyways, we'll talk about, we'll move on a little bit because this is a structural problem in the custodial fiat-backed stablecoin space right now. So there's these quarterly attestations that Tether is doing. They're not doing full audits. There's no real-time reporting. And historically, they've used these non-bank lenders in the background to fill up any gaps that they may have. So reserve composition has repeatedly changed only after public pressure, okay? So they've had large exposure to Bitcoin, gold, secured loans, corporate bonds. And another thing is they haven't necessarily been segregating their assets. So if one thing goes down, it could affect all of their entire operations. Now, this is why the S&P has called the stability of Tether weak. They've literally got the worst rating now. So the Genius Act was supposed to change everything. 100% reserves and liquid assets, regular independent audits, clear AML KYC, freeze and seize compliance, and creates a domestic stablecoin category. So this labels foreign stablecoins like USDT as higher risk as they do not fall under this framework that the Genius Act is supposed to give. So that is when Tether immediately rolled out this USAT, fully Genius compliant version of USDT. They have Anchorage Digital as the issuer. And something that's really important to note here is that they have a custodian for the stablecoin that is Cantor Fitzgerald. Okay, this is the company of Secretary of Commerce Howard Lutnick. Okay, so that's one piece of what's happening with USAT. On top of that, the CEO now of USAT is Bo Hines, who was the former executive director of the President's Council of Advisors on Digital Assets in the White House. Bo Hines was there for like 6 months in the White House, and then immediately goes right into working with this USAT. Like literally stepped down from that before the job was done to go and work on USAT. So the strategy of this USAT thing is to maintain U.S. markets access, to avoid foreign stablecoin restrictions, and to compete with USDC in the institutional market. So massive pivot that was forced by U.S. regulation. But on the other side, USDT is still doing what they're doing, and they're the largest stablecoin. So it doesn't really matter what USDT is going to be doing. USDT is the largest stablecoin in the market, and they're continuing to put more risk on by buying up gold and Bitcoin with their reserves. Now, something I want to make clear here is that this can change in the future. All right, the lack of transparency is something that can be solved with blockchain technology through what are called decentralized oracles. So right now, custodial stablecoins depend on bank solvency, auditors, human trust, and legal compliance, whereas decentralized oracles can solve a couple of problems. One of them being real-time third-party attestations, And the second would be autonomous use of this information in financial transactions on blockchains. An example of this would be Chainlink's proof of reserve. So, for anyone who isn't familiar with the decentralized oracle, the idea is that we're taking information that exists off chain and bringing that information to an on chain environment. So, as an example, if we had treasuries that were inside of a bank account, I could use a decentralized oracle to attest to that information. I could have different people verifying that information. I could have S&P could say, oh, okay, I've got eyes on your bank account. I can see how many treasuries are in there on your brokerage account. And Moody's can also see, oh, okay, by the way, yeah, I attest to the fact that as well, I can see from the oracle that I'm providing from their bank account that they have what they say they have in their bank account. And now we can create transactions on blockchains based upon the fact that we know that all this information is legit. Now, you can use the oracles without having to use all of that information on the blockchain. Just being able to attest and say, hey, check, yes, it's there. Yes, check, hey, it's there in real time would be a really, really big deal on its own. So anyways, just wanted to bring this up because we're going to move into that world. And this is what all these regulations are going to bring in. So eventually. And so the thing that we need to get to this point is we potentially would need to have real world assets and tokenized treasuries. Because if we tokenize the treasuries, then the treasuries now exist on chain. And if the treasuries are on chain, right, and we know that they're backed, right, once again, we would still want to have the brokerage accounts having a live feed of what's in the brokerage account. But if you have tokenized treasuries, then you can also now take those tokenized treasuries, report that information on the blockchain natively, and then use those tokenized treasuries in financial transactions across all of blockchain. So anyways, we also need to have Chainlink proof of reserves adopted as a standard in general. And we see a lot of that work being done with the DTCC to make all of this possible, to where eventually we will have full transparency of what's happening in the background of all of these large financial institutions. And we'll know in real time whether or not the treasuries that they say they have are actually in their brokerage accounts and can be used as collateral, for instance, for these stablecoins that they're out here issuing. Now, will Tether collapse, or is this one big conspiracy? The bear case is this. Obviously, they have a history of misleading statements and have even been sued and by the government itself on whether or not they backed their currencies with their stablecoin 1-to-1, and they haven't. We still today have ongoing disclosure gaps. Every quarter, they do an attestation, which is not even a full third-party audit. You have high exposure to volatile assets. You have a weak S&P rating. You have regulatory pressure from the Genius Act and the USDT systemic to crypto, right? If that fails, then you have a catastrophic event. It's not something that, like, if Tether just completely blew up one day, or if it just lost its peg by like 50%, that would blow up the entire crypto market. And it would probably blow up a lot of stuff in the traditional markets as well, as a lot of hedge funds would go under. And any of the people that are lending money to them would also go under on all that money that they've lent out to the entire crypto industry. Now, the bull case is that, look, you haven't had any failed redemptions from Tether. So there's massive profit margins that also Tether is generating from their Bitcoin holdings, as well as their treasury holdings, right? All the interest that they're earning on those treasuries, they're just pocketing that. So if there are gaps, right, in what it is that they need to pay people for the stablecoin, if it lost its peg, there's a nice amount of a buffer in just the profits that they're making from the treasuries as well. There's also global usage for this thing beyond the US. So if the US regulations come in and say Tether's not great here, there's still some moat that they have in other places. And obviously, there's a big role that Tether has in emerging markets outside of it just being in the US. Instead of it just being used in crypto, it's also used as just like, I don't want to hold my money in Venezuelan money, pesos. I would like to have my money in Tether because I know that at least the USDT is more stable than my currency here in Venezuela. So the middle ground is that, like, I don't think that USDT is going to collapse, but long term, I do think that it gets regulated out of the US and it's going to be replaced by compliant stablecoins like their USAT version, USDC, PYUSD, or even some of the favorites for the people that watch this channel, RLUSD. So anyways, that wraps up what I wanted to talk about here. I just wanted to kind of lay out what exactly is happening with Tether. Why are they buying up gold? Why are they buying up Bitcoin? Is this going to lead to the collapse of Tether? And why is this such a big deal? So hopefully that was helpful to you. If you did find this helpful, be sure to like and subscribe to the channel. Let me know what you guys think of these kinds of breakdowns in the comments down below. But until next time, it's Keith D, and I'll see you. If you enjoyed this, then you would absolutely love my show with Ben Levitt called Memes and Markets. We go live every Tuesday and Thursday at 12 p.m. Eastern, where we go into topics like this more in depth and in real time. Click the link in the description to subscribe to Memes and Markets, and I will see you over there on Tuesday and Thursday at 12 p.m. Eastern.